Welcome to the BankTalk podcast, the show where we talk to leaders and experts from the community banking sector. Whether you are a current CEO or aspire to be one, this podcast will give you valuable insights and advice on how to run your financial institution better. Each episode features a different topic and a guest who shares their experience and knowledge with us. Tune in and learn something new with BankTalk podcast.
Hi, and welcome to Bank Talk. I'm Charlie Kelly, your host and partner at Remedy Consulting. We've had some requests from some of our listeners on just topics that we need to cover a little bit more of here on Bank Talk. One of them seems to be risk and fraud, and we've got a few episodes upcoming on that. The other one was data analytics, and we've done several data analytics episodes in the past. But I thought what we would try today is to try to dial that in a little bit. And maybe start talking about, once you know your customer, what types of things can you do with that? So I've asked our guest, Mac Thompson, who is the president and founder of White Clay, to join us today and spend a little bit of time talking about some specific things that banks are doing with the information once they know their customers. Specifically, I wanted to spend a little bit of time on the retail side. I wanted to spend some time talking about relationship pricing. And then I thought about what the equivalent might be on the commercial side. Once you have a lot of customer data, is there a way that customers use products, that banks and credit unions use products to identify how to treat their customers? And the closest thing I came up with was commercial account analysis and products like that take into account the overall relationship and, just more or less what you can do with that to give customers preferential treatment based on, their spend with your organization. So without further ado, let's get to Bank Talk. Okay, welcome back to Bank Talk. Today I have with me Mac Thompson, the CEO and founder of White Clay. Mac, I appreciate you joining me today.
Thank you. Excited to be here.
So, Mac, we prepped for this a little bit. I wanted to talk about two things that are kind of specific to data analytics. I think, keep me honest, but I think, Mac, that White Clay lives in the data analytics space a bit. And so rather than kind of talk generically around data analytics, which we've done on previous podcasts, I wanted to spend a little bit of time just talking about what you do with the information. And by that, I mean, I think know your customer is becoming more and more relevant, and I know you have some insights on there, which we'll get to as we move along here. But when I think of what you do with the info that comes out of a deeper knowledge of your customers, two things jump to mind. The first one is on the commercial side. I think of this product that used to be called commercial account analysis. I'm not sure if it still is these days. But, it's basically a product that allows you to, more or less understand what the relationship is and how to price it. And then on the other side, when you get onto the retail customers, there's always been this product called relationship pricing, and everybody calls it something different. But, more or less, again, a way to say, let's take the value of the relationship as we know it from the data and try to figure out what we're going to do with that information. So if you're good with talking to those two, I'm going to start with commercial account analysis.
Okay.
If you don't mind, give us the ecosystem around these types of products. Like, what have they historically done? Is there anything new in this space? Just give the audience a better understanding of what commercial account analysis means.
Just for clarity, are we talking about the account analysis systems at a bank? Or are we talking about analyzing customer relationships?
Well, let's start with the first one. So,
Okay.
These systems that come around and say, this is the commercial account relationship. Give us a little bit of feel for what those types of things typically have done.
So typically, let's say historically, lots of them are built around trying to execute a transaction, usually a lending transaction, about where do you price a loan. They've really focused more on the lending side until recently. And that was mostly driven from banks were trying to grow loans. Deposits were readily available. Liquidity was everywhere. It didn't cost much. So historically, most of them have been trying to put together a relationship to where do you price a deal, and it's more transaction oriented. With the shift in from where liquidity has become and capital utilization is becoming a lot more important, we're really moving back to relationship banking, which we haven't really focused on as industry for a while. We've talked a lot about it, but we really didn't focus on it, especially in the commercial world. It was mostly around loan pricing. And how it works is they would typically pull data from your core, so your core loan system, your core deposit information, put it in some sort of model that could either be a web application, an Excel base for a lot of smaller banks, or it could be incorporated into your core. And they're trying to get you to figure out what the price is for that loan to get you to a minimum hurdle rate. And it's really a calculator of sorts. And that's how they've been using it for a while. A couple problems with that. Since in the last 15 years, we've been adding all kinds of products, right, that aren't on the core anymore. So if you have wealth products, if you have ancillary loan products, if you have ICS deposits, if you have just lots of different things, it is increasingly challenging for the banks to be able to pull 30 different systems together and build one overall customer relationship. So like on the commercial side, you might have, you can pull a tax ID, usually called CIF in banks. But if you need to pull the 20 different CIFs that are related to that relationship, that's a challenge for most banks to do. So building a full client relationship, it's just from a data perspective, has been a challenge.
Would you mind if I unpack that for a second?
Yeah.
I think what you said, as far as the dynamics around pulling the data, I think I heard two challenges there, and keep me honest, right? So number one, the tax information, the way I think about that, if Mac has three different companies that he runs under three different tax IDs, or his social security number is tax ID
Right.
for the company, right? That's one dynamic around it. And then the other dynamic I heard was, even if you had that information, you may not be able to simply pull that from your core, because there are peripheral products out there these days that are not necessarily tied to the core. So you kind of have two different ways to split the data up that would tell you that maybe you don't have everything in the relationship unless you really kind of have a little deeper dive on the data analytics. Is that fair?
Correct. Yes.
Okay. Right.
Both are challenges.
Okay. So within the commercial, you mentioned something earlier, and you'd said within the commercial space, right, it had typically been about the loan. Has that changed at all now? In other words, that concept of a relationship based on how much can I lend Mac based on his, three businesses, right? As liquidity has become a problem, has the way that people that, whether it be banks, credit unions, whomever, value the relationship, the deposit relationship changed at all?
Deposits weren't even really talked about very much 2 years ago. And now deposits are first thing you talk about in a relationship, and loans are really second.
Okay.
Because the key to profitability on a commercial relationship is whether or not you have the operating accounts and the deposits. If you just have the loan part of that relationship, you're probably being adversely selected with price. So you bought rate because if you don't have the operating accounts, their operating accounts are somewhere else, which means the primary relationship is probably somewhere else. And you were able to originate that loan because you essentially were able to outstructure or outprice their primary bank.
But you may not
their
have
primary bank is someone else.
I got you. Yeah, because you didn't bring the working accounts over or something.
Yeah, those operate. If we do customer profitability, and we can get into that if you like to. But the number one indicator of whether or not a relationship is going to be profitable is probably whether or not you have the operating account. If you have their primary operating account, that's the first question to answer in terms of building great relationships and profitable ones.
Yeah, it's a great perspective, and we've talked about that a little bit before, but kind of having that primary relationship requires a primary operating account, I think, right?
Oh yeah, and moving those are so hard. If you get them, it's really hard to move them because it takes about, if you're commercial, it takes about commercial kind of size customer, it's about 6 months to move them. Small business banking is probably about 3, and it's not easy. So it's critical for retention, but also once you have that primary operating account, your pricing power is a little stronger. You're not with, no one's going to leave you over 25. Depends on if you're in very large loans, but 25 basis points is not a reason to move your relationship somewhere else.
Right, because it's just too hard. It's too difficult.
Yeah.
Let's go into a little bit of detail around pricing that commercial relationship. If you have either a commercial account analysis system or some other system that allows you to define, what Charlie's relationship looks like versus what Mac's relationship look like,
Yeah.
is that scientific as far as what rate you can provide either of those two customers, or is it still sort of off the cuff based on how many times I golf with the guy in the year?
I would say it is mathematical, but there's still a market element, right? I mean, if the math, I give you market element right now. Large balance money market accounts are running somewhere around 5 to 550, and they're up there. The economic value of that, if you were to apply the math to it, is probably not that. But from being able to build your balance sheet out the way you want to be able to maintain liquidity without having to go into wholesale funding, it's probably what the market's requiring. The actual economic value is probably more like a 12 months rolling on a 5-year, which is about 5-year FHLB, right? I think its last 12 months would be like 436 or something. But the market's actually pricing this stuff around 550. It just happens to be we're at the high end of a rate cycle with an inverted yield curve. But can't ignore the market. But back to the other part, yes, there's pretty well-known math. I actually teach bank pricing and profitability at the ABA's graduate school, Stonier Graduate School. And so in this pretty well industry standard kind of approach to it, where you take what the customer's rate is, either on a deposit or loan, you do a process called funds transfer pricing, which essentially for a loan is if you had to go out in the street and fund that loan, what would be the cost of those funds over the life of that loan? And you go through a match term funding process, which basically tells you, hey, if you're going to generate this 5-year fixed loan, this is what the cost of funds would be for that. And you charge the loan to the use of the cost of funds. And for the deposits, the FTP process essentially gives them value for the use of those funds. But that allows you to begin looking at the interest side for both loans and deposits in a more consistent way. You then need to go through, look at how fees are going to flow through, because fees are, depending upon the product, can be very important. You then look at expected loss for loans. What are you potentially, what's the risk? So a riskier loan gets more expected loss, a better loan gets less. What are kind of the costs around that? And you can look at either marginal, fully loaded. And then how much capital is this going to consume? And you can use economic, you can use regulatory, depends upon your bank's balance sheet and where your constraints are. Regulatory usually just looks at lending products. Economic looks at both. But all that's math, and it can get if you apply that across the products that you have, so your loans, your deposits, your wealth, your analysis accounts, your services like merchant and purchase card, and you put all that together, you can get to what your relationship profitability is in the return on capital for your clients, and you can understand how you're helping them generate value on their side, but also how are they helping you generate shareholder value on yours, and that's a mathematical process.
Okay, that's great. That's very interesting. So let me ask you another question. If I generate a value, whether that be an economic value, what have you, for Mac's relationship, as a banker, do the bankers then tell that to Mac, right? Like, do they, in your opinion, have they kind of gone in and said, I don't know, again, I'm not sure if this is how we see your relationship to us, because again, that's on Mac's side, that's what's Mac's paying the bank, right? And on the bank side, that's a positive, but you know what I mean? So Mac might think of it as a negative. But more importantly, what I'm paying you back on your deposits, any of the other side of the relationship, are they actually physically going out there to explain that to their customers so that their customers don't, think that they are not on top of it?
I would strongly say not to.
Okay.
What I would do is I would use that information to inform how you're going to generate value or customer experience on their side. So when they're coming in and they're looking at they want a new rate on their money market relationship. You use this to inform what you can and you can't do. But it's not about defining how we see it. It's using that information to optimally solution how the customer is going to see it. How we look at it internally, I don't know if the customer cares. The
That's a
customer
good
cares
point.
about how they experience it and how their cost of value is from their perception. But you should use it this is one of your earlier points. You have a lot of deposit-rich customers out there that the bank's been ignoring for 15 years that actually are extremely profitable, can very much help you strategically. You need to know who they are, and you need to start working on building those relationships to be sure those customers are appreciated, be sure that they understand the bank values them, and they get the appropriate services and touch points that are appropriate for that relationship. And banks got out of this business. Banks were pretty good at this, actually, in some ways, before 2008, and we kind of got out of that business for the last 15 years. So.
Okay, so I think what I would say there is, and I think you made this point before, but just to make sure I can wrap this up a little better for the listeners. I believe that banks, over the last several years at least, the banks have said, "Hello, Mr. Commercial Customer, your value to me is in whatever I can lend you," because the bank can see a 300 basis point margin between what their cost of funds is and what they're lending at.
Yep.
Right. And again, that's the old earn 3% and be on the golf course by 3, right? But I think as this liquidity crisis has come about, maybe what you may be saying that hey, don't forget the person who has maybe their working capital accounts in your bank but do not have a loan, because at this point, if you assigned them a loan officer, the loan officer wouldn't have anything to do, right? I mean, if that's the historical relationship, or the relationship has looked that way in the past several years, you may be ignoring them, not just because of the way you're built. Did I get that right, or did I overshoot that?
We'll be right back.
If you're dealing with a technology vendor, consider giving Remedy Consulting a call. At Remedy, we're dedicated to helping our clients get the most out of their tech spend. If you're considering changing one of your major tech providers or are renewing a contract with a vendor, the Remedy team may be able to add some value. Our clients enjoy our deep experience working inside these major vendors, and that background helps us ask questions which eliminate headaches and expense for our clients. Sometimes that's immediate relief, in the way of your vendor invoices, and sometimes that comes in the form of contract language protection for a strategic move that you may want to make several years later. The group of experts at Remedy have years of experience in core systems, digital, mobile, payments, item capture, commercial banking, pretty much the whole gamut of technology for financial institutions. Remedy approaches the BankTalk podcast the same way we approach our client engagements. We always try to fill some knowledge gaps, but also just have enough life experience stories to remain entertaining. So if you're renewing a technology contract or you have projects going on, just need another opinion or a project manager from outside your organization, reach out to us at remedyconsult.net. Thank you, and we appreciate you downloading the BankTalk podcast. Now let's get back to our episode.
That's how banks perceive it. You actually will make more money on your deposit side, your liability side from a bank than you will on your lending side. I'll just give you traditionally. The last 10 years has been a little weird on that, but I'll give you an example. So a non-interest bearing deposit, you're paying 0 for the funds. The value of those funds, let's just say right now they're about 4.25. So you've got a 425 basis point spread on that. Plus, you're going to get a decent amount of fee income if you can sell them services, merchant, account analysis, other services, transactionary services you provide. On the lending side, let's say you can get to 300 basis point spread. You still got to pay for expected loss around that and the use of all that capital. So
that's very interesting. Yeah, I never would have thought.
So the actual spread on this is the money market's a little different, and but the ability of the banker can actually, if you had a choice between $100,000 of non-interest bearing deposits, $100,000 of lending, you probably go with the deposits. Now, you need both because they live in a complementary relationship. But to your point, a lot of commercial bankers think of themselves as lenders. And if they want to talk deposits or account analysis or anything, or the services, they bring in other people. The issue from my perspective on that is you're only looking at half the relationship. And frankly, lending is extremely important, provides capital, provides liquidity to those businesses. That's great. But all those other things, account analysis can really help their cash flow. How you're dealing with your merchant can change how that cash is coming in. There's a lot of valuable services that you can help your business clients with by doing the deposit side as well. You need to do both. And just focusing on one, I think, has been a misstep in the industry.
Just again, maybe it's a change of mindset a little bit, but something to consider as you talk about both sides of the relationship. If your relationship manager with any of your commercial customers is actually called a commercial loan officer, right?
And a lot are.
Yeah, they are. Yeah, they absolutely are. I'm not sure if I'm a depositor without a loan. I'm certainly not feeling the love. I'm not feeling the love as much as the retail customer who walks up to the window and talks to the teller, right?
That's true.
Honestly, right? I mean that is, and this is with somebody who's got potentially quite a bit of dollars in the working with that financial institution.
But understanding who your customers are and understanding how they contribute, and also what their needs are. But all that's together. But most banks don't understand who their customers are really. They know who the top 50 or 100 lending relationships are. Depends what size of bank you are. They know a lot of those. They know when a big loan gets originated. But did you know that there's a customer out there that's had $10 million with your bank for the last 25 years? And you know who they are, or has 500,000 or 100,000, but it's been with you forever, and you've been in. It's really beginning to it's to have each of your bankers understand who are the customers that they're responsible for, understanding who they are, and then figuring out ways to help them do whatever it is that customer is trying to do, but do it in such a way that the bank itself is also benefiting from that. Hopefully, you're trying to solve for a win-win. This isn't a one wins, one loses. That's when it's working right, it doesn't work that way.
Yeah, excellent. Okay, Matt, these are great perspectives. And I think we've touched the commercial side pretty heavily. I want to jump into the retail side a little bit.
Yeah.
And specifically, one of the things I want to talk about was a product called relationship pricing. And I don't even know if I'd call it a product. Maybe it's a methodology, maybe it's a system.
Yeah.
But can you touch upon what relationship pricing means on the retail side? And again, I'll set this up by saying, if I have a theoretical customer who has an auto loan with me, maybe a mortgage, doesn't have a home equity, and has $20,000 in deposits in their accounts, or 10,000 or something, their standard account. How does give me a feel for sort of the ecosystem around what was typically known as relationship pricing on the retail side? How do you start thinking about that?
Well, just first is building that relationship like what we talked about on the commercial side. But on the retail side, there's another really critical component, which is fair lending and ramifications around that, because you really there's a lot of very appropriate things you need to comply with. So relationship pricing becomes less of a custom price per customer, more so it's not a custom price per customer so much as it is a methodology for segmenting your customer groups and building service and sales strategies around them, but you've still got to price them on the lending side very equitably. And I think that that's critical. The other piece of this is deposit-wise, I think there's some real questions around equity there. Is how do you be sure you're not doing things that are creating bias around how you're doing pricing? I just start with that just because it's a pretty hot topic out there right now around how all this works. Are you giving all the high interest rates and deposits to particular groups and not other groups, even though they may have everything else the same? And if you are, then you got a problem. So, but when I think about relationship pricing in the consumer space, I think more of it is grouping them based upon behavior. If you have retail customer where you have the operating relationship, so you're their primary bank. If you ask them who their bank is, it's you. That might only be 60 to 70% of your customers. Some of the other ones, you're the secondary or third bank in their relationship, either with a loan or a savings account or some account for some reason. But figuring out who those are. And then once you figure out kind of who those are, how is it that the customer chooses to optimally work with the bank? Are you where they keep their excess cash, or do they put that somewhere else? Do they transact a lot with you? There's lots of behavioral things around this. And what you then do is begin figuring out, based upon these behaviors. I'll give you an example. If you're a heavy transacting customer, your duration with the bank is probably your life with the bank, and your customer lifetime value is probably going to be significantly higher than someone that doesn't have the operating account, that only has $5,000 in a savings account left over from 10 years ago or 3 years ago. But it's really about figuring out how to handle those segments and optimize those.
Because we've touched on this conversation before, call it the primary account relationship.
Yep.
Specifically in that consumer space that we're talking about. If you were to try to determine, you used a figure of 60%, maybe 60% of your customers are, and I know that was just a figure you tossed out there, but maybe 60% of your customers you have the primary relationship for. What's the indicator? Is that a direct deposit? Is it like what in your head? Is it number of transactions? Is it, how many times they're using a specific, bill payment product? Like
the easiest thing to do is look at transaction counts by month. I mean, if you just want to rule of thumb kind of thing.
Right. Yep.
If you have a DDA account that a relationship level is doing 15 or more transactions, you probably have the primary operating. I'm talking consumer.
Yep, sure.
Business, it's a different number. It's small business. As you get bigger, it's a different number. But if you're talking just straight up consumer, it's probably around 15 a month. I'm talking real transactions, not internal bank. So if it's a check, a debit card, ACH payment, something.
Yeah. Okay. So it's real money.
There are people out there that talk about, well, if you have 2 ACH deposits, we have their operating account. No, that just means the payroll goes into your account and then they ACH it out somewhere else. That by itself doesn't tell you that. It's a good indicator. It just doesn't tell you that you're the primary operating. So it's about 15 transactions.
15 transactions. Okay, and that's that's great, because I think historically, most banks would say if I can get their paycheck deposited,
yep,
right, that would, and again, I think it's probably just a correlation between the two, that that tends to be the place you go, then do your 15 transactions out of. But yeah, I've asked that question to several guests over time, and I tend to get different answers. But that was a good one. I think you hit that one on the head. Okay, so really, the relationship pricing, given specifically Fair Lending Act and a few other things, the concept behind relationship pricing might be who's the most likely customer to buy the next product. Not necessarily, do I give Mac 50 basis points better than Charlie? It might be using that intelligence to try to determine whether I have customers whose needs I'm not meeting, because Charlie has 3 indicators of things that he probably uses as banking relationships, but I can't see his vehicle loan. So somebody else has got his vehicle loan, right? Or whatever. Right. That concept of an upsell might be more the way some of these relationship pricing products have come about than anything else. Is that?
It might not be the next product, but it is listening to their needs and satisfying them. One of the things I think banks got too into was pushing a particular product on a client. And it might be that they're in the right products. They just need some help using them. But it's about understanding those, so relationship pricing, relationship management, is more of a strategy about how to optimize segments of customers. But I think I do agree with you. It's about figuring out what those segments value. I'll give you an example. If I used to work for a very large bank once upon a time, and we had a very large ATM network. And this is somewhat dated, but we had people that use the ATMs a lot. Someone said, "Oh, well, let's go charge them a fee because they really like ATMs." But if you thought about the value proposition of that customer, the reason they were with us was because we had a great ATM network. And if you penalize them for using it, you destroy that particular segment of customers' value proposition. And it's about understanding that. in that
Yeah,
segment.
right.
Does that make sense?
That makes perfect sense, and I think it's a good example because it's a little dated, but you can pick out 5 other ones just off the top of your head
Yeah.
that have the similar scenario, right? Just know what your customer's there for. Again,
If they what do they find important about this relationship? What is their and you really need to go seek that out. The number one things about big pricing, people setting pricing is your customer does not think like you. I mean, we are bankers. We're analytical. We do math. We love analyzing the hell out of things, and our customers aren't really that way. Some of them could be, and they probably are. Others aren't, and so don't think the customer thinks like you do. Go ask them. Figure out what it is that drives the value proposition from their perspective, and be sure you're delivering that. Because if you are, they're a lot less price sensitive.
oh, for other things that they're purchasing. Yeah, no, that's great.
Because if you're getting great value, are you worried that it might cost a little bit more than someone else from your perception?
Right.
Probably not.
Okay, last question, and you've done a great job with this, so I appreciate it. The last question that pops to mind is this one. As I think about the one thing we haven't talked about is winning new customers, and by that I mean, so you have all this relationship pricing data, and I would assume that it's at a certain point you've determined. Let's just use we'll use the consumer side again. You've determined that Charlie does 15 transactions. Right. So we have his primary relationship. Based on the data analytics, is there a way to then define who Charlie is as a user? And again, this goes back to your concept of they don't think the way bankers think, right? But is there a way to define that Charlie is X number of years old and he has, these types of transactions, or he's got this many loans, or he's this, this a place within his life, and we need more of those. Is there could you have one easy example of ways to use the data analytics to build the customer base rather than just, retain and cross sell?
Yeah. Just what we just talked about. If you have figured out certain groups of customers, these are their value propositions, right? So you figured out this group particularly values these things. When you're talking to prospects, you can figure out which ones they are, which of those value propositions they're interested in, and talk to them about that. Because talking to them about a general value proposition for your bank, that's not very compelling. And usually when you're doing this, I'm more familiar on the business side of this. We I'll go consumer for a second. A lot of times we're doing promos and rates, and we're trying to entice them solely on pricing. And that gets, it's a normal consumer mentality. But on a commercial side, business side, most of the time, if you're out prospecting, you're trying to go build a relationship with someone that's got to relate their primary, they bank with someone else. And you're essentially there waiting for the rebound, because it's going to take an event. It's going to take a bad customer experience. It's going to take something to make them look elsewhere. Because people don't wake up in the morning and think about banks, right? I don't think about my banking account when I get, right? They want to do something else. Usually if they're thinking about it first thing in the morning, there's a problem. But whenever those events happen, it could be a life event, it could be a business, it could be something that triggers this. You want to be in a situation where you can build this. You're there for that rebound. And you have to be positioned for that. And I think understanding what motivates that particular kind of client by talking to them and then selling the value proposition that they're interested in, not necessarily whatever promo it is you're pushing. I think that is a way that you can couple all this analytics, though, coupled with messaging and understanding of your customer together, is how you can really drive that growth.
Yeah, that's great. And really, I mean, when you think about everything we've talked about here, as far as I know why customers like this bank at this location. Right?
Yeah.
I know who they are, who those commercial customers are, why they find the value. That becomes a lot easier conversation than just dropping the generic material on them. Because if I'm shopping for banks and I read through their material, I don't know that I can discern the difference between it.
Yeah.
It all sounds the same. I mean, it's probably built by the same marketing people or whatever. But
they're susceptible to a promo rate, right?
Right.
That means they're probably going to be susceptible to the next promo rate.
Yeah, if I can get them now, somebody else will get them later.
Yeah.
Well, Mac, thank you. This has been very helpful. It's been a pleasure to have you. Is there anything we've missed or anything else that we need to talk through, or did we get most of it?
No, no, I just, we're going back to relationship banking, which I personally think is great because I've been banking for, I don't know, a long time. But focus on delivering value to your customers, making sure you get paid for it. And that's relationship banking. And I think it's great. So your listeners enjoyed it. So.
Thank you. Yeah, we do appreciate your time. Okay, well, that's it for Bank Talk. Appreciate Matt joining us today and providing some insight on just how to think about relationships in general and, specifically on the consumer and on the commercial side. I think he provided some good insights. So for Bank Talk, this is Charlie Kelly, your host. Have a good day and keep on learning.
Thank you for listening to the Bank Talk podcast brought to you by Remedy Consulting. To reach out to Mac at White Clay, go to whiteclay.com. Thanks again, and we'll see you in the next episode.